All right, what are we talking about?
We are talking about mortgages today. Hi guys, today we're gonna talk about everything that the first-time home buyer or the second-time home buyer needs to know about lending and mortgages. If you're in the market to refinance, we're gonna touch that too. But most importantly, we're talking about first-time home buyers today and how the lender will help you achieve a dream of owning a home. With us today, we have Daniel Carocho.
Hey everybody.
He is with Absolute Home Mortgage right now, and he is closing on average 80 deals a year, and he knows everything about lending side. So we're gonna ask him all the important questions. So number one is, what is a pre-approval and why do I need it?
Why do you need a pre-approval? Well, you need a pre-approval to shop for a house because without a pre-approval, you don't know what you can afford to spend. What a pre-approval is a cross-reference of your income, assets, credit, liabilities, and then we put it all together and then put it in a hypothetical housing payment, and then we're able to figure out what you can actually afford to pay.
And what documents do I need to get pre-approved?
Depends on what you do for a living. So if you're a W-2 wage earner, we need your most recent W-2, your most recent pay stub, your most recent bank statement. We need to just soft pull your credit. We can do a pre-approval from that. If you're self-employed, depending on how long you've had the business, we either need 1 or 2 years personal or business tax returns, bank statement, and the soft pull credit report again.
So when I get a pre-approval, will it affect my credit score?
It depends. There's different types of pre-approvals, which we'll go over later, but your most basic pre-approval, we can soft pull, so would not negatively affect your credit score.
What does soft pull mean?
A soft pull means that there's not going to be a credit inquiry on your credit report, okay? A soft pull is a less invasive credit score check than a hard pull inquiry would be.
Mm-hmm. And can I, as the first-time home buyer, shop around for different rates, or will my rate be the same with every lender?
Your rate is going to differentiate from lender to lender, but it's not going to be a huge swing. If somebody's telling you it's going to be 6%, don't think that you're going to go to the guy down the block and get 4%. You're usually shopping for roughly 1/8 to 1/4% on the interest rate. So ultimately, you want to work with somebody that you're the most comfortable with, right? You might be able to get somebody on the internet to give you a lower rate, but a lesser service. Right, and
then they can also charge upfront fees that
Correct.
would cover for that.
Correct. So what you're talking about, discount points, is prepaid interest, and a lot of lenders will advertise super low interest rates and not tell you what the actual fees are, and then when they go to lock in your interest rate later on down the road when you're actually under contract on a house, they'll charge you points. That's what we call bait and switch. It's a negative practice that happens way too frequently in our industry, unfortunately.
So they give you a lower percentage, but then they charge points that you're not aware of.
Correct.
When you're getting pre-approved.
Correct.
So ask the lender about the points before you go with them.
So if a buyer is saving up to buy a house, how much is a safe amount to save before purchasing?
Really depends on the purchase price of the house. Believe it or not, there's products out there right now for financing for first-time home buyers, which is 100% financing. And you can do seller's concessions where you can get the seller to contribute towards your closing costs. Theoretically, you can buy a house with no money out of pocket. You guys being in the industry realize that when you're trying to negotiate with those types of pre-approvals, it limits your ability to purchase a house that maybe...
It's really hard to do that in New Jersey because competition is crazy.
Right. Yeah. So as a first-time home buyer, you have your conventional options, which are 3% down, right? You have FHA, which is 3.5% down.
And that is what a lot of buyers get wrong, that you need 20% down. Mm-hmm. No, here is our mortgage lender telling you don't.
No, you don't. Even if you're not a first-time home buyer, you can do 5%, you can do 3.5% on an FHA. There's a lot of different options out there for a lower down payment. I'm currently working with a client right now where one of the things they wanted to do was consolidate all of their other debt by selling their house, and then the proceeds of that sale were used to pay off revolving debt, student loans, and then they did a lower down payment on the mortgage because when you amortize over 30 years or you break up that payment over 30 years at, let's say, 6%, you actually get a positive cash flow. You're putting, even if you upsize on the house, right? So they went from a $400,000 house to a almost $600,000 house, right? But they consolidated $80,000 worth of debt by selling the house, and their overall payments, their overall debt situation is actually less on the $600,000 house than it was on the $400,000 house.
Yeah, and because also mortgage is the lower interest
Correct.
than those credit cards and the high interest payments. So then you would be in a better financial shape doing that.
Correct.
Also, a lot of buyers are confused. If you have student loans, can you still buy a house?
Oh, yeah, absolutely. So student loans, depending on what type of student loans you have, may be in a payment plan or you may be in deferment. So if student loans are being deferred right now, you can do 0.5% of the actual balance. So if you have $100,000 worth of student loans and those payments are deferred right now, we would have to carry $500 for the payment, but you can still purchase the home while that student loan is in deferral.
And then, so you mentioned conventional and FHA. Can you go down some of the advantages and disadvantages of the loan types?
Sure. So conventional is going to be about 70% of the loans that are written in the marketplace today. Conventional loans are a little bit less strict on the appraisal process. They are more strict on credit score. They are also more strict on debt to income ratio. Okay.
How much is the credit score for conventional?
That's a loaded question because it depends on the down payment, right? So there's automated underwriting systems that we're going to take these loans and we're going to put them through. And depending on whether or not you can clear automated underwriting, it would depend on whether or not you can get a conventional loan, right? Now, the one thing to remember is conventional loans have something called private mortgage insurance. Private mortgage insurance at less than 20% down. So if you put less than 20% down on your purchase, you're going to pay private mortgage insurance. Private mortgage insurance is an algorithm, okay? It's based on credit score, it's based on down payment, it's based on DTI or debt to income ratio, it's based on property type, it's based on geographic region, it's based on number of borrowers, okay? And occupancy, whether it's a primary residence, whether it's a second home, whether, those things all get put into a machine and then a number is kicked out. There's multiple providers for private mortgage insurance, so we're going to shop all the majors, and then we're going to put it in there. Lower credit scores are not going to price very well on a conventional loan for private mortgage insurance, where FHA is a fixed mortgage insurance premium, right, at 0.55% at 3.5% down. It doesn't matter what your credit score is. As long as you can qualify for the loan, the mortgage insurance is not going to change. So a lot of times, if you have a middle of the road credit score, the FHA is going to price better, meaning the interest rate and the mortgage insurance is going to equate to a lower monthly payment and give you more buying power. So a lot of times as first-time home buyers, you're looking at that product if you have that, let's say 600 to 680 credit scores, even almost 700, depending on what your debt to income ratio is. It may actually be less expensive to take an FHA loan versus a conventional.
And also, here is the question too. When you calculate on Zillow that monthly mortgage payment, is that accurate?
Tarina, you're making me nauseous. The Zillow mortgage calculator is horrific. It doesn't properly calculate taxes. The homeowner's insurance is all off. The mortgage insurance is all off. They have no idea what your credit score is. Their interest rates are one day may be accurate. The next day could be off by 0.5%. They are so far from the accurate. Please call a local lender and find out what you're actually qualified for, because that is going to drive you batty if you try to shop with that thing.
So one of the questions I know, like me and Dorina work a lot with first-time home buyers. One of the questions we always get is because of how the market's priced right now, you're getting less for your money, right? What can you do if you're a first-time home buyer, you don't want to pay rent anymore, but you know that you're going to have to go into a larger home in 3 to 5 years? What can you do between the FHA and conventional to switch it over to an investment property possibly if the market's not in a place to sell?
Okay. So theoretically, if you vacate a primary residence and then you rent it out, the note, the debt instrument that's written on all the primary residence loans say that you're supposed to refinance that into an investment property loan. In practice, it doesn't happen.
Okay.
Right? As long as you're saying that you're going to live in that house for 12 months as a primary residence, what you do with it after that is between you and the current mortgage servicer, right? The note is going to tell you to refinance into an investment property. I will tell you it doesn't happen.
Yeah, of
Right.
course.
The terms on investment property loans are not as good as primary residence loans. There's more risk on investment property because people will tend to pay for where they're living versus an investment if things start going sideways in their career or if you have a bad tenant or for whatever reason. You're always going to put a roof over your head and your family's head before you put a roof over somebody else's.
And we will have another video touching only investments. That's another thing to do, right? So there is, when you're buying a house, there is a check that no buyer is ever ready for. That's closing costs. And can you touch base on that, how much they are and what they consist of?
Sure.
Just like little by little. And what if you're not asking for the seller's concession, what the buyer should be expecting
Sure.
to pay.
So when you purchase a property, there is closing costs, whether you buy in cash or you use a mortgage company to purchase a property. The first thing that you have to consider is that when you purchase a piece of real estate, you should use a real estate attorney. They're going to protect your interests. They're going to review the title insurance. They're going to review the title work. They charge usually anywhere between $1,500 and $2,000. So let's just say $2,000 on the high end, just to make the numbers nice and round. Then, depending on what the purchase price is, you have title insurance, right? Title insurance is going to be based off the purchase price, but let's say on a $400,000 house with settlement, title insurance is going to be $3,000. That brings us up to $5,000. You have your escrow account. These are your prepaid items, okay? This is your taxes, your property taxes, and your homeowner's insurance. It's a requirement that you pay the first year of homeowner's insurance up front. Then they're going to collect up to 5 months, even 6 months at times, of property taxes at the closing for the first quarter that is due, and up to 2 to 3 months in reserve, okay? So depending on what the property tax is, that's going to escalate it as well. Bank.
If you're buying cash, you don't have that, but then you have the lending side.
Correct. So just lending and closing costs, what you should be looking at as the bank fee, how much they're charging for processing, underwriting application, credit score, appraisal, credit report, appraisal, and if they're going to charge any discount points. Those are really the bank lending costs.
The
Everything else
appraisal is paid by the buyer at the closing as the closing cost, or is it paid before?
it's part of the closing cost, but it is paid in the beginning. So that is the only thing that you're going to pay up front if you do business with Absolute Home Mortgage. Once you go under contract, you're going to do home inspection and you're going to do appraisal right away. Cost of appraisal is anywhere from $575 to $900 depending on the property.
And then how much does it cost to apply for a mortgage?
Zero.
Zero. You only pay when you close.
That is correct.
And in a lot of real estate stuff, you only pay when you close. So
Correct.
if you end up not buying a house, then you're not paying for a lot of it.
You brought up an interesting point there. So I've been in this business 13 years. You've been doing it how long?
10, 11.
10, 11. David's been going on, 5, 6 years now? So combined, we have 30, 35 years of experience. You could literally pick up the phone and call either one of us and get all three of us in a room and ask us 1,000 questions for free,
Yep, exactly.
right?
We do buyer consultations, which are free. It's about 45 minutes to an hour when Dan is going over all your documents. He will tell you how much house you can buy, what you can do to improve your score and to improve your interest rate, what mortgage you should apply for if you qualify for down payment assistance on any government plans, if it's good for you or not to do that, which we will touch point on that too, because that's the number one question any buyer asks.
Sure.